6 mortgage questions you must ask your lender before signing on the dotted line. When shopping for a mortgage, it's well and good to think mainly about the size of your monthly payment. However, you should consider many other factors that have an equally big impact on the mortgage and your decision-making process. Here are 6 key points to discuss with your lender before you sign on the dotted line. Watch the full show to make sure you're properly informed about the entire process. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. I'm doing marvelous today. It's summer, everything is cool, and the weather is wonderful. If you are doing as great as I am, go grab a cup of coffee or tea or vodka, and let's roll. Today, I want to talk to you about 6 questions, only 6, no more. 6 questions you must ask your lender before signing. Number 1, is this a fixed rate or adjustable interest? So the thing here is that a lot of new homeowners are going for fixed rate mortgages, right? Or ones where the interest rates stay the same over the length of the loan. So if you have a 30-year or 15-year fixed rate, that means you're paying the same amount over the loan period. However, since ARM, this is something called ARM, adjustable rate mortgages, they typically start out with rates that are much lower than either the 30-year or the 15-year fixed rate. And this might sound a little attractive for some people, and you have to think about your particular financial situation to see if it works for you. There are certain things you need to think about if you're thinking about choosing an ARM. Again, ARM stands for adjustable rate mortgage. Be sure to ask the following questions: how long will the initial fixed rate period last? How often does the rate adjust after that? How is the adjusted rate calculated? What is the rate cap? Or in other words, the highest my rate can go. It is very important. Those 4 questions will help you decide whether or not it is a good decision. Because like I said, traditionally, banks will sort of entice you with a low ARM. So they probably will tell you, hey, listen, we'll start you at 2%. And after 5 years, we'll just bump you to 6 or 8%. And that can have a huge impact on your financial life. So those are things you have to think about. You have to budget this not only today, but also in the first 5 or 10 years. Remember, a mortgage is a long-term affair. This is not a car loan where you just buy and pay off over 5 years. You'll be stuck with that house and that mortgage for 15, 20, 25, or 30 years. Now let's talk about a few things here. Are adjustable rate mortgages a good choice? Now, it really depends on your financial situation, because an ARM can certainly save you if you are in that sort of category. It can save some buyers cash up front, right? But it's not the right choice for everyone. Though the loans do offer a low rate and lower mortgage payment at the beginning, it's critical that buyers realize that those savings are only temporary, right? So generally, ARMs will come with a fixed rate period, as I said earlier, of anywhere from 5 to 15 years rather, meaning the interest rate will remain stable for the amount of time. But after that, you never know, things will go up. Now, who should not use an ARM? There are some buyers, according to research, who should steer clear from an ARM from the get-go, particularly those on the hunt of their forever home. In other words, if you are thinking about buying a property where you will be spending the next 25 to 30 years, then you really want to go with a fixed rate. The last thing you want to worry about is, when it comes to buying or building your dream home rather, is a mortgage payments that adjust. Remember, as you grow older, chances are your income will go up. But what if something happens? What if you lose your job? What if you lost your job and you can't afford the payment anymore at a time when the interest rate goes up, meaning the mortgage payment also goes up. So you really cannot afford that. So another thing that you want to think about, if you want to buy a vacation home, then you don't want to use an ARM. Why? Because vacation homes are secondary residences, and you will try to sort of compensate the loss of you want to reduce your cost of maintaining the property if you're not living in there by renting it. Now, the rental industry is very seasonal and cyclical. So if you have a bad economy or some kind of issue in the particular area where your property is located, chances are tenants are not going to show up, and you don't want to have on a property that does not generate income consistently. You don't want to have a cost that is changing, particularly when that cost goes up. All right. Now, that's the first question. So is it a fixed rate or adjustable rate mortgage? Second question, what interest rate can you offer me? It is very important that you want to ask this question up front. Ask the lender to give you an idea. It could be a range from 2% to 6% or 8%, depending upon your credit score and financial situation. You want to hear from the landlord clearly what kind of rate they are thinking about. Why? Because you don't want to waste your time. Because the last thing you want is waste your time focusing on one lender while there are gazillions of lenders out there who just want your business. So you want to be able to get a clear idea of the cost of this mortgage so you can compare and contrast with other lenders in the area, right? So one thing that's very important is that, as I said earlier, the rate you're given depends on your credit score. It also depends on the economy. It depends on the property market in the particular area where you want to buy the property. Now, remember that according to myfico.com, the best interest rates are still available for those with higher scores between 760 and 850, right? So you can save and shave a lot of cost from your interest rate if you have a high credit score. Okay, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still having a conversation around the 6 mortgage questions you must ask your lender before signing on the dotted line. Question number 3. Does the rate come with points? Also known as the buying down rates, points are generally fees that you can pay to the lender at closing in order to secure a lower interest rate and, by extension, lower your monthly payments. Now, as a rule, 1 point will cost you 1% of your total mortgage value. However, the rate we've seen in the industry by which your interest rate decreases is not standard. So it is something that's variable, and it varies by lender and also by sector. Now, if you're considering buying points, it's critical, and this I cannot emphasize this enough. It is critical to look at how long it will take you to recoup their cost. So you need to think about finding your break-even points, and the way to do that, you have to divide the cost of the points versus how much you'll save on your monthly payments. So the resulting number is the number of months it will take you to get back your initial investment. For instance, let's say you have the cost of the points is we're just going to try to make it very easy. The cost of the points is 12,000. I'm exaggerating here, but 12,000. Right? So what you want to do is you want to divide 12,000 divided by the number of months, right? So that will be what? So you have $12,000. So, and you're saving, let's say you're saving about $1,000, right? $1,000 every month. So 12,000 divided by 1,000, that's 12 months. So you're actually recouping your investment in 12 months. If the savings were $100, you would be recouping your investments in 120 months. So that would be 10 years. So this is the kind of calculation you have to make. If you want us to go deep in this kind of calculation, please put it in the comment section. We'll dedicate an entire show on explaining to viewers the importance of buying points during the mortgage process, and how to recoup your cost, and how to calculate the break-even point. All right. Now, if you plan on staying in the home for longer than the amount of time, points may be a worthwhile expense, right? Because you know that you'll be making money, you'll be saving money after the break-even point. However, if you plan on moving faster and sooner, you want to consider putting that money towards your down payment instead. Let's talk about question number 4. What fees are you charging? You want to have a clear conversation with the lender around the fees they're charging. what do I mean by fees? Origination fees, or fees charged by the lender to cover the cost of processing the loan, work a little differently than your other closing costs. Now, so rather than getting collected from you at the time of the settlement, this one-time fee, I'm talking about the origination fee, is taken out of the amount that you borrow. What I'm trying to say is, if you're borrowing 300 grand for the property and the lender is charging you an origination fee of 10 grand, you're getting 290. So, and additionally, that fee is expressed as a percentage of the loan value rather than a flat rate. So we've seen in the last 10 years the origination fee fluctuating between 1% and 5%. In California, it's very high, and they tend to be high for premium properties. So this is something you have to think about. So you want to ask your lender what their fee is percentage wise and how much you should borrow based on that rate. Because remember that you need to have enough money to pay for the property. So if they are charging you, say, 5% origination fee, and you're borrowing 100 grand, you're not getting 100 grand for the property. You're getting 95,000. So you need to borrow more and account for their fees so that you're comfortable, so you have enough money to close the deal. What I'm trying to say is, let's say you want a property that costs, say, 120, right? 120,000, and you're putting 20,000 as down payment. So you need to finance the property up to 100,000. And if the bank is charging you 5% origination fee, you're only getting 95%. So you need to borrow somewhere around 105 or 106, 107. I can't get the math correctly on this one, but you got to borrow around that neighborhood, 105 or 106, 107, so that when you after deducting the origination fee, you still have 100,000 left to close the deal. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a great conversation, I assume, around the mortgage questions you must ask your lender before signing on the dotted line. If you love the clarity and quality of the content so far, please consider smashing that like button, share this content, and subscribe. Turn on the notification bell. Don't forget that, so we can push on to you new shows that you might like every single day, and we do this every single day, rain or shine. Comment below. Let us know your opinion, your comment, your experience about first time home buying, or what kind of questions you asked your lender in the past. We want to hear everything. Question number 5: when can you lock my rate? Now, what is a rate lock? This is when you have a rate lock on a mortgage. This is, in essence, a guarantee from the lender that your rate will stay the same for a specified period of time, no matter how they fluctuate industry-wide. So let's say, for instance, usually in the industry, if you have a high credit score, the bank wouldn't mind going for 6 months. So they will lock your rate for 6 months or 1 year. In some investment property deals, banks have been known to lock rates longer than 6 months. So the thing here is that, but I would say for people with average credit score, the lock periods, it's somewhere between 30 to 90 days, right? Now, as interest rates continue to climb, that window has been getting smaller. Again, it depends on the industry, because banks are businesses. They have to account for cyclical fluctuations. They have to account for endogenous processes, endogenous internal issues, and also external factors, right? So if at all possible, you want to make sure your closing date falls within your lock period, right? So if the bank promised you to get a 5% interest rate on the mortgage, and the lock period is let's say for 3 months, you want to close the deal within 90 days. Additionally, you want to ask about the specific terms of your lock period. So you want to ask if there is a fee for locking in at a certain interest rates. Additionally, you want to see whether the rate has a float down clause, meaning you'll be eligible for a lower rate if they happen to fall. Question number 6: am I expected to get private mortgage insurance? Now, what is PMI? PMI kicks in. PMI stands for private mortgage insurance. PMI kicks in usually when you put less than 20% down payment on the home. So if you put less than 20%, the answer to that is yes, because a smaller down payment means that you have less of a stake in the home. Private mortgage insurance is made a requirement to protect the lender's investment in the event you will default on the loan, right? So Congress believes that if you have a quarter of your skin in the game, if you have 20% of your own money in the property, you are showing like good faith. You're showing that, I have a skin in the game and I'm going to stick around. I'm not going to default on this. So you want to ask your lender about your options. Most conventional loans will require PMI until you've paid down over 20% of the loan. Now, however, FHA programs require that security for the entire length of the mortgage. I'm talking about the PMI. So VA programs, Veterans Affairs Program, on the other hand, often will waive this requirement for eligible applicants. So the thing here is that you want to think of you have to weigh how much your PMI will affect your monthly payment versus the benefit of making a larger down payment or switching loan programs, right? So it's, because either way you're going to pay. You can either pay this through PMI, in other words, you pay the mortgage, your monthly mortgage, and then a little bit in the PMI, or you put less money up front and you reduce your mortgage payment, right? So this is it, folks. I hope that the conversation was very helpful to you and fruitful. And let me quickly recap. Here are the 6 mortgage questions you must ask your lender before signing on the dotted line. Is it a fixed rate or adjustable? What interest rate can you offer me? Does the rate come with points? What fees are you charging? When can you lock my rates? Am I expected to get private mortgage insurance? Here you have it. I will see you next time. But until then, remember, stay marvelous.